Hey everybody, I hope everybody had a good holiday season, good Christmas, New Year's, all the fun things with family and friends. We're going to be kicking off 2025 with, it's going to be a very interesting year. Um, anyway, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending January 10th, 2025. I'm Preston Brent, and thanks for tuning in. Well, the theme this week is price to perfection, and that's what we have with the U.S. stock market. Uh, PE ratios are very high. Earnings are forecast to come in double digit this year. We've got inflation worries. We got interest rates staying higher. I don't believe the market's going to be able to thread this particular needle. So why don't we just get started and just take a look at how the market fared this past week, really the first couple of days into the new year, and then we'll just jump into it, okay? You can see this past full week, everybody was in the red. Dow, S&P, NASDAQ, Russell, year to date, everybody's in the red. So not starting off the right way in the markets. In fact, NASDAQ down the most that it's been down in its biggest weekly drop actually since mid-November, right, of last year. So a really big drop here this past week. Now, this past Tuesday, we got the ISM. They reported their PMI data. That's a measure of economic activity in the services sector. It came in at 54.1, right? That was 2 points higher than November. So very strong. Anything over 50 is a positive expansionary kind of thing. It also showed that prices paid by services organizations increased by 6.2% to 64.4. So that started to put stoking the fears, I guess, of inflation. The progress of bringing down inflation is kind of stalled, right? And adding to those fears, we had the Fed governor, one of the Fed governors, Bowman. He came out and said that inflation is held uncomfortably above the Fed's 2% long-term target. Okay. He said they did make progress in 2023, but he said that there are still upside risks to inflation. So the markets didn't like any of that. And then, of course, on Wednesday, we got the Fed meeting minutes, which pretty much echoed the same sentiment as the Fed Governor Bowman, right? And then finally, what really capped the week off was the Friday jobs numbers for the month of December. Labor Department reported that the monthly non-farm payrolls came in at 256,000 jobs added for the month. Now, the markets were expecting 155,000. Huge bump up, huge. And the unemployment rate actually came down from 4.2 to 4.1. So the minute that hit, stocks turned really lower and just had a really horrible day on Friday, pushing everything down. And normally when you get this good news, good economic data is bad for price action. Well, it has to do with the Feds and interest rate cuts. This pushed out the forecast of just how many rate cuts the Feds are going to be doing for this year, 2025. The minute that jobs number hit on Friday, U.S. Treasury yields jumped up um, to, I think the benchmark 10-year yield hit the highest level since November of 2023, just on those job numbers. So that's going to put some downward pressure on the equity markets, big time. You can see the PE ratio, the forward PE ratio on the screen, the upper right is at 23.43. Now, some of them have it at 22. It just depends on how you calculate forward earnings. But let's just say it's high all around. The dividend yield for the S&P, 1.26%. 10-year Treasury finished out the week at 4.77. Now, a lot of people, me included, believe that once or if the 10-year Treasury yields hit 5% or a little bit higher, it's going to be even more bad news for equity markets. Okay. I mean, if you look at the earnings yield right there at 4.72%, and then the S&P yield over the 10-year Treasury, well, guess what? The 10-year Treasury is paying more than the S&P earnings yield, and the 10-year Treasury is considered a risk-free investment. So a lot of big money is saying, wait a minute, I can get a risk-free investment. I don't have to, play this equity market, especially going into a new year with a new president and markets really unsure of how tariffs are going to work, what they're going to do, what's the effect on the economy, inflation staying sticky, higher for longer. U.S. debt, which I haven't mentioned, is through the roof. So it's going to be a very interesting year. Okay. You can see VIX, obviously, for the week closed it out. It was up 21.14% from prior week's close. So, all in all, it's not a very solid foundational start to the year. Okay. You can see the best performer for the week was energy, up 1.05%, year to date 3.19%, primarily because um, Biden put more tariffs on Russia, closing off more oil. Now, Trump is expected to come in and put even more tariffs on Iran, but he wants to drill in the U.S. to offset the lack of oil coming from Iran and Russia. So we'll see how all of that plays itself out. It'll be a push-pull this year for energy. And then, of course, the worst performers for the week, both weekly and year to date, is real estate. Shouldn't be surprising. Interest rates staying higher for longer. That's what you get, right? Now, if we go across the pond, you'll see over there, everybody in Europe was in the green for the week. But understand Europe is having a hard time of it, even though they were in the green. This is kind of like a dead cat bounce, okay? First of all, in Great Britain, the Treasury market's trying to calm the markets and reaffirmed its commitment to all of their fiscal rules that they've been talking about because they had a big sell-off in the pound, the British pound. And they had a big sell-off in U.S. government bonds. All right, they call them the gilt, the 10-year gilt. The yield moved up to 4.8%, even higher than the U.S., which was at 4.77%. Okay, it's the highest level of the 10-year British gilt, or the 10-year treasury, is the way we call it, since August of 2008. So that spooked the markets a little bit over in the UK, even though the FTSE was slightly in the green for the week and slightly in the green for the year. Okay, there's a lot of concern across Europe, especially in the UK, on Trump policies and tariffs and the outlook for U.S. interest rates. So that could really affect all of Europe. Meanwhile, in speaking of Europe, the ECB said in its latest economic bulletin that the disinflation process was well on track, meaning they are actually reducing inflation, bringing it back down to their target of 2%, right? So the odds favor a little bit of a divergence in interest rate cuts. Normally the Feds lead the rates higher and lead the rates longer in all the major economies globally, but I think this year you're going to see Europe standing off and probably cutting more than the U.S. Fed. Now, if we look at the Asian markets, they're all in the red for the week, all in the red, kicking off 2025. In Japan, the yen weakened to about 158.1 against the U.S. dollar. I think the weakness in the Japanese currency is pretty much attributable to the uncertainty about further monetary policy across Japan, as well as the differential in the U.S. Japanese interest rates, and then what is Trump going to do with tariffs there as well. So it is affecting the global markets at this point in time. Meanwhile, Ueda, who is the governor of the Bank of Japan, he's basically has maintained their tightening bias, but he basically reiterated that rates will be raised if economic and or price conditions keep improving. So there's a big bets going on and when the Japanese are going to raise the rates 25 bips. Now, inflation and wage growth over there, which is a key indicator in Japan for consumer purchasing, fell 30 basis points year over year in November. That's the fourth consecutive month of real wage growth falling. So Japan's got their issues, guys. And then China is even worse. Their inflation is showing that they're still in almost a deflationary, stagflationary kind of environment. Okay. Now, the People's Bank of China did come out and say that they're going to continue to loosen monetary policy to support economic growth. So right now, Japan and China are really the two major countries that are still pumping money into the economy. So this year is going to be very interesting, and I know a number of market analysts are calling for the SPX. I've seen high numbers of 6,700, but I've also seen low numbers of 5,500 for the S&P to round out the year. In fact, Goldman Sachs came out and said over the next decade, the S&P will average 3% a year. I think Morgan Stanley's a little bit more bullish, but Morgan Stanley came out and said it'll be around 7% annualized over the next 5 years. So either way you shake it, the market's going to have a harder time having this trajectory to the upside that we've seen over the past 2 years. Okay. Remember, we came out of a bear market in 2022. So we've had a little bit of a bear market bounce. We got that in 23 and 24. So now the bounce is over and the markets need to go up on their own with real earnings growth, real profit margin growth. And it's going to be much harder with interest rates staying higher for longer. So that's a little bit about how we're approaching this year. What I want to do is let me just shift the screen a little bit, take you over to the E-mini S&P 500 futures. We'll just take a look at some key charts, key asset classes, and see how things are shaping up. If we're starting with the E-mini S&P 500 futures, you can see my target was really, it's almost time and price. My target for the E-minis was 58.22. We had an intraday low on the 10th of 58.45, but we're in the red, as you can see. You can see the closing price of 20.24. So we're in the red. All right. The market started off the year very robust, but then just pulled back dramatically over the past week. And this is kind of where we're sitting right now. And then, of course, if we look at the Dow, see how the Dow is doing. Same thing with the Dow, right? In the red for the year, above the 200 EMA, below the 50, pretty much the same with the S&P. And we're in the red, not by much, just 1.83%. But you can see that the 50 EMA has got a downward vector now. The 200 EMA is starting to flatten. MACD is well below zero. This tells me that any rally right now is probably, or the higher probability, is going to be sold off. If we look at the equal weight SPX by itself, again, dropping off dramatically starting in the early part of December, and then any rally has been sold off. So that means the mag companies have been doing a little bit better, right? So if we look at the Magnificent Seven, you can see here, while they're down, they're not as much as equal weight. They're above the 200 EMA, just barely holding it up. You can see here, it's almost right at 2024 close. So almost a break even for the year, but a little bit stronger. The mag so far is still outperforming value as I see it. If we come down here and look at NASDAQ 100 futures, you can see here below the 50 EMA, above the 200 EMA, not in the red too much, but we're still in the red for the year, okay? Again, a downward movement here indicates that any rally more than likely is going to be sold off. And then finally, if we look at the Russell is also just not having a very good start to the year. It's down just slightly under 3%. You can see how it held up at the 2024 close, and then it finally broke. It started to break on Thursday, and then a hard break on Friday. Okay. So that's a little bit about where I'm seeing the markets right now, at least the major indexes. Any rallies probably going to be sold off, so just anticipate that. Outside of the Magnificent Seven, we're sandwiched between the 200 and the 50 EMA. We got earnings kicking off next week, next Wednesday. We got a lot of money center global banks coming out with earnings next Wednesday. We got PPI on Tuesday, CPI on Wednesday, which are inflationary type economic data points. So we got enough next week to keep the markets hopping. And of course, if we come down here and we look at the VIX, you can see here with the VIX, right in this area here, we're not in the red, but just barely in the, almost barely out of the yellow zone. So we did hit a 20 handle intraday Friday, but it pulled back just a little bit. Now, if we look at the back month volatility skew, you can see here, this compares January, February vol futures. We're in the green. We went in the red intraday, but we're back in the green again. So this tells me a lot of this fear, at least at this present time, is mostly centered around near-term fear, not longer term, okay? And then if we take it out and look at the January-July volatility future spread and look at the skew, you can see here about the same as the back month skew. We're in the green, which you would call contango. And that just means that the further out in time you go, the higher volatility goes. When volatility goes higher with the front months, that means you're in a backwardation, which means the markets have a lot more fear in them. Okay. If we look at the front month, in other words, let's compare the VIX and the January vol futures. It's in the red. So we're in a backwardation. But remember, these were going to expire very soon. And when they do, then the VIX equals the January volatility futures. All right. They expire end of day on Tuesday, not this Tuesday, but next Tuesday. So we'll see where this is, but we're in a short term, little bit of a fear going on right now, which should not be surprising. Okay. Now let's look at the interest rates. Let's look at the 10-year rate. Okay. The 10-year rate has just gone through the roof, right? This was my target, and we actually blew right through it and we moved up. It's 22 basis since the start of this year, right? We're up 22 basis points. The high point was on January 10th, okay? It's at 4.79 roughly. It was at 4.57 to close out 2024. And if you look at the 30-year interest rate, it's going to be the same thing, right? Blew right through my target, up about a little, just slightly under 22 basis points for the year. And you can see my target here, and it's at a little over intraday high over 5%. Okay. Should the 10-year Treasury, we'll go back to the 10-year Treasury for just 1 second. Should this 10-year Treasury get over 5%, it's going to spell a lot more trouble for the U.S. markets. Now, this is an Elliott Wave 5, an extended one, so it can move up a little bit higher, but I'm not expecting too much more height in this. My system is calculating just slightly under 5%. But most people, me including, believe the 10-year rate is going to stay kind of between 4.5 and 5 for the first quarter of this year. Now, inflation can drive this up even more if we have some bad inflation numbers. Okay, and that's coming out this Tuesday and Wednesday. So we got to pay close, careful attention to this. Now, if we look at the currencies, naturally with a stronger interest rate, the dollar is real strong. And again, we blew right through my target here as well. And we're up 1.42% in the dollar, 109, the dollar index, 109.825. Okay. So naturally, once we see the dollar getting stronger because interest rates are staying higher for longer, if we come down here and look at the euro, well, the euro is going to be just the opposite, right? It's going to be a mirror image of the opposite. So if we take a look at the euro here, you're going to see it's right at my target. We hit new lows on January the 10th. It's down 1.41%. So 1.0241 to the dollar. This was my target for the euro. I don't see much more upside or downside in the euro, upside in the dollar, unless we get some difficult numbers out of inflation. Now, keep in mind, we get the Fed's meeting in January, but it's at the tail end of January, the last few days in January. And on Wednesday, they're going to come out with their policy. So it's going to be very interesting to see what they're going to do and how they're going to signal the markets with interest rates. We're already seeing some Fed governors putting back on the table that we're going to push out. We're going to take our time in rate cuts, and even a possibility of a rate hike could be in there. That is not going to be good news for the equity markets if we start to hear more Feds talking like that. Okay? Of course, if we come down and look at gold, it's been nothing but up for the year. Kicking off January, you can see right here we're up intraday 3.63%. But you can see the 50 EMA and the 200 EMA have an upward vector. Here's a 2024 closing price at 26.39.3, and we're sitting right now at intraday 27.35. But you could see where we closed at 27.17. So just I do believe gold can go up a little bit higher. I was expecting actually gold to go a little bit lower than this over here back in November of last year, but it kind of held up, and now it's just getting choppy as it's moving higher, right? But I do see more upside in gold right now. Same thing with silver. Silver is also moving up off the lows. That was my target for silver. It just cleared the 50 EMA. You could see the intraday high on the 10th. All of these precious metals, silver, gold, they love the jobs numbers coming in strong. Interest rates probably staying a little bit higher. The equity market's selling off. So precious metals, especially gold, tends to like that environment. Although traditionally, with a stronger interest rate, higher interest rate rather, that gives you a stronger dollar, which tends to push gold and other commodities down a little bit in price, but we're not seeing that this year, at least to start off the new year. Okay. We look at energy. Energy is having, it's like I said earlier, it's leading the pack for sectors this year. You can see there's really been no down day. We kind of settled in here, and then boom, we went up. Intraday, we were up 8.33% on the 10th. A lot of this is due to the recent sanctions that Biden just put on Russia. And now it's going to be, oil market's going to be very interesting in 2025 this year when Trump gets in and he starts to enact some of his policies. Some of them are very bullish oil, some of them are very bearish oil. I do know that Trump basically does not want gasoline prices and oil to stay high for longer. So it's going to be real interesting to see how oil price action reacts to some of the Trump's policies that he puts in place. Nat gas, let's look at nat gas. Now, nat gas, I am a believer in more upside, right? You can see here, this was an intraday high back over here on the end of December. We'll probably come up and we'll test that, okay? And what's happening with nat gas is Biden, closed off the LNG terminals in the Gulf of Mexico, or according to Trump, the Gulf of America, to ship over to Japan and over to Europe. Now, Trump's going to open them up, and he's going to bring in a lot of people, hire a lot of people, and start, sending the nat gas, liquefied natural gas, LNG, over to all these countries. That's going to be a lot of buying, a lot of producing. So it's more bullish nat gas than bearish, right? So that's a little bit about where I'm seeing the energy market playing itself out right now. All right, everybody, that's just a quick roundup of some of the key asset classes and the indexes as we go into 2025. Members, I will see you Sunday evening for our 7 p.m. weekly market watch. Take care, everybody. Ciao now.